agenda.
Okay.
Good evening and welcome to the Finance and Claims Committee of the Normal Common Council for today, Thursday, May 12th, 2022, beginning at 7:02 p.m. Calling the meeting to order. The second item on the agenda is the roll call. Councilmember David Hooverman,
Present.
Councilmember Tom Keegan,
Here.
Councilmember John Kites, who I do not see as of yet, Councilmember Jen McMurray.
Present.
Thank you. Councilmember Nora Nadelsky-Eichner,
Present.
Councilmember Diana Ravalis,
Present.
and Councilmember Greg Burnett's present, so we have a quorum. Thank you. Item 3 on the agenda is public participation. We did not receive any emails prior to the meeting. Is there anyone waiting to or have their hand raised to speak? I don't see anyone at this time. Do we have any communications received by any Finance Committee members which they wish to share at this time? Okay, seeing none, I'll close public participation and we'll move on to item 4, which is approval of the minutes of the Finance and Claims Committee meeting from April 14th, 2022. Do we have a motion on the minutes? Councilmember Jen McMurray, thank you. Do we have any additions, deletions, corrections to the minutes? I did not see any, so okay, very good. So with that, I'll call for the motion. I'll call for the vote. All those in favor of the minutes as presented? All hands are raised. It's unanimous. Thank you. Moving on to items 5, 6, and 7, which are the Claims Committee report. Received the monthly claims report, review and approve claims as required for claims report dated May 12th, 2022. And we'll migrate to the narrative on the tax collector's report dated May 9th, 2022, and follow that with the monthly tax collector's report dated April 22nd. And we have our tax collector with us, Lisa B. Hello, Lisa.
Good evening. I actually don't I forgot to bring the claims home with me, so I don't know if you want to share your screen or if there are any special requests. It was so long ago that I looked at this, I don't even remember.
I will share my screen.
Okay.
Hopefully you can see it now.
I certainly can.
Great. Let me scroll down to the claims report. Here we go.
I don't think that there were any special
I don't
requests.
see, I don't believe, I scrolled to it and I did not see.
Okay.
I'll scroll very slow. I
Okay.
did not see any claim over $10,000 listed.
So
Yeah.
just for the sake of clarity, if there are no claims in excess of $10,000, this is basically for informational purposes only. Nothing has to go to a vote on that. So with your permission, I would move ahead to the monthly report, the spreadsheet, and also the narrative that accompanies it. As you can see, as of the end of April, we're 10 months into the fiscal year, and we were at nearly 99% of our levy, but that levy, I made a notation that levy did get reduced significantly due to credits that were issued as a result of those court cases for assessment appeals. So it is very good news that we are at 98.98% as of the end of April, but part of the reason that is so high is because the collectible levy, the actual receivable, did decrease nearly $4.7 million year to date. So I'm just bringing that to your attention. It's neither good nor bad. It's just a neutral, but that's where we are. We're ahead of the game in terms of what we need to do to close our fiscal year and to try to start wrapping things up, which is where we need to be April and May, looking ahead to the new billing. This is not a tax sale year. Next year is. So what we're doing this year, instead of real estate enforcement, we're kind of focusing on business personal property enforcement by issuing alias tax warrants and doing bank garnishments and things of that nature. We've actually been doing really well. We're issuing about 25 new warrants a month. And that's going really well, but that's what we're doing in terms of enforcement. We also have a wage garnishment in effect for City of Norwalk and Board of Ed employees who are Norwalk taxpayers. If they do owe back taxes, we garnish their pay directly from the city. We work with the payroll department in Chitsame's office, and we appreciate their help. We're still working with the health department to have them decline to renew any health permit for any business establishment that owes personal property taxes that are delinquent more than 1 year. That also is going well. We very much appreciate their help. As you can tell, there's a lot of different tentacles that we put out, and we depend on other divisions for help in our enforcement actions. The Board of Estimate and Taxation did set our tax rates for the coming year. Like I usually say, the reason why we do as much enforcement as we do is to try to enable them to set those rates as low as they can because of the amount of delinquent revenue that we bring in and how high we keep our current collection rate. So they did set those rates. We already have those rates in our software, in our training environment, and we're looking forward to probably towards the end of this month, doing a trial run with the bills and have the bills go out in the middle of June. It's probably going to be a little bit later this year. There's some staffing issues. And right now we're basically waiting on some processes that need to happen in the office of the assessor. That's the office, the division on which my division relies for data. So they do their magic, and then they turn it over to us and we bill it. But if all goes according to plan, bills should be in the mail sometime around the middle of June. I'd say around the 15th to the 20th of June. Taxpayers still have until August 1st to pay, but we do like to extend that collection period out a little bit longer, make it a little bit easier for everybody by getting the bills out early. So the only other thing I have to mention is that since the last time I spoke with you, we did conclude our work on the 2021 tax sale, and the redemption period expired in the middle of April. And what that means is the properties that we did sell that didn't come back and pay off the bidders, those properties were deeded over to the new bidders. And as it turns out, there were only 4 that happened to, and 1 that the city took due to there being no bids. So out of 248 properties that we started with, only 5 changed hands. And all the rest we were able to collect the taxes on, with a total of approximately $9.5 million on that sale that we started working on in November of 2019. And I'm glad to field any questions that you may have.
Yes, we have 2 hands that have been raised. Councilmember David Hoovman, followed by Councilmember Nora Najelski-Eichner. David?
Thanks, Chairman Burnett. Hey, Lisa, you just mentioned staffing. I know at one point you said you were back up to full steam. Where are you at?
My office right now is we have 8 full-time people normally. Right now, we do not have 8. We had a new hire that we brought in the first week of December. That hire didn't work out, and that employee is no longer working with the city. So we are down to 7, but one of those is also dealing with some medical issues working part of the time from home and part of the time in the office. So we really only have 6 that are there on a regular basis. 6 out of 8, and we're managing the best we can. It's probably going to be a little bit challenging over the summer. What I did the last time when we had issues of staffing the window, we scaled back our hours a little bit. We haven't done that yet. I'm trying not to do that. We're open from 8:30 to 4 now, and I hope to keep it that way.
You mentioned though that you are that it looks like it may be a little bit later getting the tax bills out, also with information you need from the assessor's office. And then is your staffing going to impact that? I mean, are we looking at middle of the month? Or are you looking really towards right at the end of June?
It's the one who does the work on the bills in my office is basically me. So my staff won't have an impact on that. What we're dealing with is a shortage basically in the office of the assessor right now. They have 3 clerical vacancies, and one of those individuals was responsible for a lot of the data entry and things like that relative to the tax bills. There's also a timing issue because in Connecticut, our elderly taxpayers are given until the 15th of May to apply for elderly and disabled tax relief programs that are run by the state and by the municipality. So we have 3 or 4 different programs with different income levels. The assessors are still taking applications from those folks, and then they have to analyze them, see who qualifies for what, make sure that everybody gets what they're entitled to get, input all that data into the system before I actually run those bills. There's motor vehicle issues. We get information from the DMV. Sometimes that's a little bit on the late side. So they're working with that. We try not to pressure them, but I'm cognizant of the calendar, and the CFO is aware of it. I shared an email with him about 2 weeks ago, giving him basically what my timetable was. And then the information came back from the assessor's office that they were running a little bit behind, which is understandable. And we're all just going to try to stay on the same page and keep each other informed of what's going on. But I just wanted to bring it to your attention because what's going to happen is those of you who are accustomed to getting your bills around June 10th, my phone is going to start ringing, and I just wanted you to be aware of it. I find that it's better to sort of face problems head on rather than have everybody be surprised. We're fortunate that in Norwalk that our board by charter does set those rates relatively early. That does enable us to do a quick and timely billing, but we're in a little bit of we're just a little hamstrung this year. So I just wanted it to be on the radar for all of you.
All right, thank you. And as always, thank you for everything you do.
You're
David,
very welcome. It's my pleasure.
can I add a point about this? There was a key resignation in the tax assessor's office, but the assessor is aware of it. I mean, legally, the bills have to get out by June 30th. Lisa obviously tries to get them out between June 10th and June 15th. It makes it better for everyone. So it's not a question of legal compliance. He's working diligently with all the issues that we're talking about. And I believe we've set up systems and procedures so that the bill should probably drop in the mail by June 15th. Again, if we don't hit it, it's not the end of the world. It's just a preference, and we like to do that, but we are limited with some resource issues.
Can I just quick follow up? How far behind are we in the assessor's office with the resignations from a staffing standpoint?
There was one resignation. I believe the assessor informed us that he might be 1 week behind from where he was in the last few years. So I don't think it's a real big issue. And I think we're going to get the bills out in time without any problems.
Okay. With that resignation, how understaffed is the assessor's office then right now?
I don't think they're that understaffed, except they do have people with health issues. So it's again, we're still not out of COVID, and coordinating and managing a process with people who may not be in the office, who may not be experts in certain areas because some people had that expertise. So it's a juggling act. again, I think we'll probably get the bills in the mail by June 15th.
All right, thank you.
You're welcome.
Thank you, Henry, for that input. Councilmember Nora Najolski-Eichner.
Thank you, Henry and Lisa. Very quickly, Lisa, I don't want to take a lot of time, but I just was looking at the collection report and noticing that it looks like there were a number of overpayments or corrections to CoreLogic and a number of overpayments or corrections to Loretta LLC. And I just wondered if you could quickly explain to me, is it sort of that a company will just process all of its requests for overpayments at once, or why were there so many to each of these entities this month?
CoreLogic and Loretta are tax services. They are a middleman between lenders and municipalities, and they
Perfect.
collect data and collect payments and remittances on behalf of mortgage holders, and then they remit to us. So there are some cases where Loretta or CoreLogic will have actually shelled out money that ends up needing to be refunded to them. In some cases, those refunds go directly back to the taxpayer themselves, so you wouldn't even know that Loretta or CoreLogic were involved. And in some cases, they go directly to the lender, so you would see the name of a bank, UST Bank or something like that. But CoreLogic has approximately 19,000 parcels that they service out of 26,000 parcels in Norwalk. They're our biggest. Loretta is not as big as CoreLogic, but
Still quite a lot.
yeah, that's what happens. And when anything happens with CoreLogic, basically I drop everything and work on that, because you're talking about like a $40 million transaction or something. So it's a lot.
Yeah,
That's
no,
who they
thank you.
are. That's who they are.
Fabulous. I appreciate that. That's very helpful to
Of
clarify.
course.
And then the one other very quick thing, when you say that a property was taken over by the city, who at the city then controls that property?
It's owned, it goes into a pool of properties that are owned by the city. And there's a lot of properties that are owned by the city. I sort of lose track of it after that. It doesn't go through my office any longer, but at some point there will probably be a surplus property auction conducted through either the purchasing department or the corporation counsel's office, or both, where they try to offer properties that the city owns that they may no longer need. This property that we took, we're not in the habit of taking properties, but it was a small piece of land that I can't say doesn't have value, because all property has value, but it didn't have the type of value that a buildable lot would have. And we offered it at, this was our third tax sale that we tried to offer at, and no one would buy it. And so that's why we took it.
Okay, thank you. I appreciate that.
course.
Helpful information.
Of course.
Okay, any additional comments or questions for Lisa? Okay, great. Well, we look forward to hitting the magical 99% next month.
Absolutely.
And you're shaking your head, meaning we're going to be there. So
We're probably already there. Yeah.
oh, yeah, there we go. There we
Yeah.
go. So
Yeah. Not
we
to
appre-
worry.
yep. Once again, appreciate all the great work you and your team do each and every month to keep the cash register open.
Trying. Thank you so much for your support. Everybody have a good night, and we'll see you next month.
Great. Thank you.
Thank you.
Okay, moving on to item 8 on the agenda, which is to receive the Oak Hills Authority monthly financial statements for March 2022. And we have on our call tonight, Carl Dickens from Oak Hills Park Authority.
Thank you, Mr. Chairman. I won't be very long tonight. So
Would you like me to bring up the report?
toward the end here, we'll talk about the slide. if that's
Okay, great.
All right. So, right now in August, we'll be begging for a lot of this rain we've had the last 2 weeks, 3 weeks, because we'll be needing it. But right now we would be okay if they just turn the spigot off for a little while, because that has impacted us a little bit. But that being said, I mean, I'll give you the bank balance right now. We have $225,000 that's in the bank. And that's after the poor winter weather. And that's after we've paid off the investments on the cart path, which has helped us. And I don't have a number on how much that's helped us, but I know that it has, where they're fully completed now, so we don't have to hold back because of wet weather and mud and that sort of thing. And the line of credit that we have to take out every year is in full tact, and it does not appear that we're going to have to touch that whatsoever between now and the end of this fiscal and calendar year. So we're okay there. It looks like right now that March year to date shows that we are underperforming by about $24,000 against our budget. However, the rounds that have been played above budget, despite the course closure and poor weather, and some of that's been helped by the seasonal passes. And now that the weather's starting to turn better, like today was a gorgeous day, we still expect to beat the budget for full year 2022, the fiscal year, which ends, what, another month or so. The only problem that we've had, and we're still struggling a little bit with, is this POS system that is now run by Golf Now, but they're making progress on it, and they've sent in some support and help. But it's some of the capabilities that it was supposed to do hasn't happened. So it's caused, particularly the financial side of Oak Hills, to do some double and extra work, and the reservation system. So people can still make reservations by calling in, or they can make reservations by going directly online to Oak Hills and make reservations. But if you use the Golf Now application, sometimes that's been a little problem for us. But we're working our way through that. As of July, we're going to be paying back to the city debt repayments of $172,000. So that's good. The restaurant is now open to the public. Hours have been a little on and off because of the weather, although we've been opening up the halfway house as much as possible. And actually the halfway house does a good trade when it's open. So there's a few issues going on there that we're still working through. So I would say that the way we're looking at the rest of this year, like the rest of the golf industry, we think we got a good year ahead. And I don't see any real problems for us, particularly on the financial side of things, through the rest of this season. So that's all good. That slide, if you can see it, that's up right now. That is an event that.
Give me 1 second to
Sure.
share the screen.
Okay.
Okay, there we go.
There we go. All right, so I mentioned this in the last meeting, and it's coming to fruition. The event date is on Sunday, May 22nd from 3 to 5. And if you guys want an individual one of these sent to you, we can do that. If not, if somebody can just print off 14 or 15 of these and pass them out to the other council members, that would be great. But this is the event that we talked about that's being totally supported by the Oak Hills 501(c)(3) supporters committee for tennis and also for the golf course. So this is a buffet dinner, coffee, tea, dessert table, cash party seat. Price is $50 per head. And this is all due to raising money that's going to go into the new patio that is going to be built. And I have a rendering of that, but I don't have it with me right now. But if you guys want to see one, I can have one sent to you. This was a lifelong dream of Art's, is to have a place to sit, chat, have something to eat, something to drink after you're around the tennis, right over by the tennis court. And it looks good. So we've got the bids out, we've got the contractor out, and we've got the money to pay for it. So, and actually it's being paid for by the supporters. So that's good. But we wanted to get together, and Denise Brown on the board has really done a terrific job of pulling this all together. This is, as I mentioned, this is a dream of Art's. And if you didn't know him, he was a sweetheart. He could also be a pain in the tushy, but he was also a sweetheart and loved the tennis court and Oak Hills. So that's what's going to take place on the 22nd from 3 to 5. And there's also a silent auction. You see at the bottom, if you would register by May 13th, but we'd love to have you all show up there, even if it's just for, a few minutes or whatever, but it would be, great support to everybody if you did, and we don't want to exclude you from that event. Head count on the Park Authority. We're having elections at the meeting next Thursday, and there's going to be some shifting around. Mike DePalma will no longer be the chairman after the meeting next week. Mike is elected not to be chairman again. He's had some big changes at work with his company being bought up by somebody else. So if anybody on this call has ever gone through that, and I'm sure some of you have, it sort of takes up a lot of your time. So he's been very busy with that. In fact, I think he's either in Chicago or Dallas this evening. I can't remember which. So moving up to replace him as chairperson will be Joe Androsco. I said he'll take the position over, which Joe will be great. Nobody knows the financial numbers like Joe does. Moving up to take my spot as vice chair will be Al Dutton. And Al's had a wealth of experience, but I do mention, as I did in the last meeting, we need to get him appointed to a full 2-year term as commissioner. So I sent Leisha a note on that the other day. We just need to get that done so it's official, so we can have him as the vice chair. And Jennifer is going to be taking over as the finance person, replacing Joe. And I think she'll do a great job with that as well. So those are some changes that will start to take place. After next meeting, they'll be sworn in those positions in the July meeting in those official capacities.
So they take office in July?
Yes.
Thank you.
You're more than welcome. And let me see my notes here. I think that's really the most relevant things to pass along to you all. I don't really have anything else. Oh, I did have a question. Diana, last that we talked, Councilman, did anybody reach out to you? I mentioned that I wanted Paul to reach out to you. Did you get anything from him?
Not to my knowledge, no.
That's fine. I will remind him of that again tomorrow.
Thank you, I would appreciate it.
Well, I want to follow up on what I think you had as a really great idea about, reaching out to the community for other people to play golf and lessons and so on and so forth.
I
But
appreciate that.
he's been a little busy too with, one day there's 200 people playing and one day there's 2 people playing. So it's been a little weird over there. And that's really it. That's all I really have right now.
I appreciate the follow-up.
No problem.
Great. Do we have any questions or comments for Oak Hills? And I see that Council Member John Cadiz has joined the meeting at 7:30 p.m.
I apologize, Chair. I for some reason, I don't know for what, I thought it was at 7:30. My apologies.
No problem. Okay, so seeing or hearing no further questions, Carl, thank you very much for that. The monthly update and the update on the officer changes that will take place in July, and we'll make sure that the full council gets a copy of the flyer of the event for May 22nd.
Terrific. I appreciate that. And thank you all very much. I appreciate it.
Great, thank you.
All right. Good night now.
Good night. All right, moving on to item 9 in the agenda, which reads as follows: receive the Board of Estimate Taxation, May 2nd, 2022. Item A, which resolution making appropriations for various public improvements aggregating looks like $38,983,540 for the fiscal year 2022-2023 capital budget, and authorizing the issuance of $38,983,540 in general obligation bonds of the city to meet certain appropriations in fiscal year 2022-2023 capital budget. Do we have a motion on this item? Councilmember David Hooverman, thank you. And we have with us this evening our CFO, Chief Financial Officer, Henry Dakowitz, and Tom Ellis, our Budget Director, to take us through this bonding request.
Thank you, Mr. Chairman. I apologize, I'm getting over laryngitis. I believe you've seen this along the way when the council set the cap. This is the final step. The Board of Estimate and Taxation has recommended this total of $38.9 million for capital projects. As I'll go into later with the debt service, it authorizes me to issue bonds. However, we issue bonds based on cash flow, not on the timing of the approvals. One of the things Chitsme and I have done is we now go out regularly to the department heads and chiefs who control these capital projects. And we ask them to estimate quarterly on a rolling 2-year basis, 8 quarters, how much their outflow is for expenditures, what their inflow is for expected reimbursements. So we get a net cash outflow by project by quarter. And based on IRS rules, we are not allowed to borrow money in excess of what we need. They have very strict what's called spend down requirements, where when we borrow money tax-free, it generally has to be spent within 2 to 4 years. We can't hoard it now and spend it 10 years from now. So consequently, our goal here in finance is to make sure we have sufficient funds so that the department heads can expend the money on the projects as they expect to, without having excess funds, which might cause us IRS problems. And that's why we do the solicitation of the information of what their projected cash flows are. So this is this year's appropriations. It's $38.9 million. The council, the Board of Estimate, the mayor have all reviewed it. And I guess we're looking for an approval. We're here to answer any questions.
So just to provide further clarity to that, Henry, we're approving the general bonding process and the amount listed here, but you're not going to go out and borrow 38 million right away.
Well, again, stealing thunder from, what number is it? Item 9 on tonight's budget about the debt service. But recall that we have 220 million of approved projects, net of reimbursement, that have not been bonded. This 38.9 just adds to that total.
Got it.
We then go out and say, out of that 220 million, what do you expect to spend in the next 12 months? And then this year, for the first time, I said, if this 38.9 gets approved, how much of this 38.9 do you expect to spend in the next 12 months? So for example, DPW, when they're doing paving and streets and sidewalks, they tend to spend the money within 18 months of approval. School construction may take 6-7 years. So we take all the approvals, we put them on a calendar, and we try to project how much will be needed for the next 12 months. We look at how much bond proceeds we have left, and then we figure out what we should do going toward the market to borrow more funds. Obviously, very concerned with the great acceleration of interest rates over the last year, and even accelerating over the last 3 months. But again, I'll talk about that.
Thank you.
You're welcome.
Do we have any questions, comments related to the resolution as read? And the detail is in the backup, so you can see the amount that has been allocated to each department, which shows the $38 million total.
And each project underneath each department.
Right, and each project underneath. Yes, exactly. Thank you. Very detailed.
Yes.
Okay, then, with that, if there's no questions or comments, all those in favor of the resolution, please show by raise a hand. Or
Aye.
verbal aye. Thank you. It's unanimous. So that will move on to the full council for approval at our Tuesday, May 24th council meeting. Which brings us to the final item on the agenda, which is the update on the city debt service. And again, Henry Dackwitz, our Chief Financial Officer, will lead the discussion along with Bill Lindsay from MUNSAC, who is, I'll say, our bonding expert, to provide further information on our city debt service.
Great. So the debt service is the technical term we use for the operating expense when we make payments of principal and interest on bonds. Okay, we pay back principal based on the term of the debt. It could be 15-year debt. It could be 30-year debt. The interest payments are based on the interest rate at which we borrowed times that principal amount. Greg, do you mind sharing your screen with these slides that we had?
Hold on, let me.
I think it's right in the agenda, right after the resolution.
Okay, hold on.
Thank you.
I'm not sure that. I don't think it was included. Is this? Oh, yes, here it is. Okay. Is this the slide you're looking for, Henry?
Yes,
Okay, great. It's up.
thank you. It's not centered. If you could move it up a little bit more so we can see the whole page.
Sure.
Great, thank you. So we tend to borrow in the summer. And once we make those borrowings, Bill, as our municipal financial advisor, generates a debt service for the new bonds that were issued. We add them to the existing debt service that we had before the issuance. And so we get the resulting debt service after that borrowing. So the first three columns are the existing general fund debt service. This was calculated after last summer's offering and has not changed. So you could see that we had 305 million outstanding in debt. If you go to the second column of principal, the bottom is 300.4 million of debt. However, we expect to pay back 25 million of the debt in the fiscal year 22-23. So looking at the net, I calculate that we had $280 million of debt outstanding. This is important because Bill ran some numbers about a year ago. We were questioning how much debt could we issue before we jeopardize our AAA bond rating. And he did a thorough analysis of all the AAA credits and AA credits in Connecticut. And we determined that based on the economic factors for Norwalk, once we have 400 million outstanding in debt, the bond rating would be in jeopardy. Okay, so reading across, the existing debt service would be the principal plus the interest, or 35 million. And if you go down that third column, P and I, stands for principal and interest, you see that it declines. it goes from 35 million down to 1.5, 30 years out. And there's a significant dip after 15 years. When I first came here 3 years ago, in general, the city did not borrow for longer than 15 years. But at the time, we were ramping up a school construction program. And financial theory says that the term of the bonds, the length of time the bond should be outstanding should be matched to the term of the asset. And with schools, we're looking at 30, 40, 50-year lives. So I made the determination in consultation with Bill that we should issue 30-year debt. And there are two reasons for that. One is that if we borrow over a 30-year period, the debt service for each year will be lower. We're repaying the principal over a longer period of time. So it gives us a little bit more room in the operating budget. The second is a term of equity. If we build a 50-year school building and we only borrow for 15 years, and the residents for the next 15 years are being burdened with paying for a 50-year asset. And the residents who are here 30, 40, 50 years from now are getting it for free. They're not paying for it. So it's appropriate to extend the term to match the term of the debt with the life of the asset. And that's why the numbers go down and then they go down significantly. But over the last 3 years, where a lot of our borrowing was for the school construction project, we've been borrowing 30-year debt. I will add that every year that we borrow, we do a rigorous analysis. Chitsame does that and works on it with Bill, and we review the assets that we are financing, because we don't just borrow for school construction. As I said before, we may be paving roads, doing sidewalks, adding a new radio system to the police. So we look at the assets, we look at the expected life of those assets, and then Bill does some magic about how to balance the bonds, how many are 30-year, 15, 10-year. Then he smooths it all over, but that's how we get to our debt service schedule, just so that you understand. Are there any questions right now? Okay. Greg, I'll go back to that slide, please. Thank you. So the next three columns are the proposed 90 million bond issue for this coming year in 2022. Greg, can you go down? Is there one more page behind this? There we go. Perfect. Thank you. If you can get to the totals, that would be even better. There you go. Perfect. So I think I shared with the committee the memo I sent to the mayor about a month ago, and it related to the timing of the cash flows. As I said, that's what I'm more concerned about when I decide to borrow. So as I've said, we've had $220 million of approved capital projects that have not been bonded. Based on the cash flow forecasts from the department heads, we expect they will spend $58.9 million next year. We did some of this data at 12/31. We've also looked at what were the projections for the last 2 quarters of this year, from January through March and April through June of 22. And we found that we had sufficient bond proceeds available to pay for the expected outflow with a very small buffer. So we're okay for the current year. So we started looking at next year. So out of the 220 million, the total is 58.9 million. We then went out and said, assuming this 38.9 million current capital program is approved, How much of the 38.9 do you expect to spend in the next 12 months, July of 22 through June of 23? And they came up with 28.1 million. When we add that together, we end up with $87 million. Given the fact that we have a very small buffer, I'd rather have a little bit extra. I don't want to tell someone who's doing a construction project that we ran out of capital funds. So I'd rather have a little bit of buffer. I have enough wiggle room with the IRS. So I'm not worried with the IRS if I have $5 or $10 million extra lying around. They're more concerned you borrow 100 million and you don't spend it for 5-6 years. So my recommendation was to borrow $90 million for the coming year, enough to fund the estimates of the department heads and to leave us with a very small buffer. We then went through the projects and I split them out into 15-year projects for most of the projects throughout the city and the 30-year projects for the building program for the school. And it came out to be, out of the 90 million, 30 million was school construction, which has a 30-year life, and 60 million at a 15-year life. Bill put together this projection and he did the numbers. Please note, TIC means true interest cost. Just to give you a frame of reference, a little less than 2 years ago, in the summer of 20, we borrowed $45 million, 30-year debt at 1.75%. Last summer, summer of 21, we borrowed $50 million at 2%. The TIC for the 15-year projects is 3.492. That's our estimate. I think that may be low. The interest rates are just skyrocketing, not even month by month, it's day by day. And in the middle series, the 30-year bonds are 3.829. It's normal in debt and interest rates that the rates go up over time. It's called the positive slope of interest rates. So if we only had 15-year bonds, it might be 3.49, but with the 30-year bonds, it's 3.829. I personally think it's going to be in the 3.5% to 4% range, given where we are. Excuse me. So he takes that interest rate with the principal and the interest, excuse me, and he gets a P&I. That's the actual debt service that we will make as a payment year by year. And we do the same for the 30-year bonds. Now, we add that together and we get the new debt service just for the $90 million, okay? Goes up to 9 million and then goes down to 1. But that, and the only reason the first year is lower is because we don't repay principal the first year to give us a little bit of cash cushion. So we're looking at 9.5 million a year and then sliding down. So that was just for the $90 million issue. Greg, if you could go back to that previous slide, please. Now, if you look at this, the leftmost 3 columns are the existing debt service, all of our prior bonds. It was 35 million. Over 15 years, we're going down to 12, and then we scale down to 1. The $90 million issue itself is looking at that 6 to 9 million at the top end, down to 1. The rightmost is just summing those 2 columns. And so you have total principal is now 395. But as I pointed out, that first year, we're repaying 25 million. So I look at it as 370 as our existing debt. And we talked about 400 being the limit. It would certainly appear that with next year's capital projects, we will be borrowing over 400 million. So we're at 395 with the 25 getting paid off. The Principal and interest payments are going to 40 million a year and then sliding down to 12 and then below. But if you look at what the prior interest rate was, the 34.7, and now we're at 41 million, that's an increase of 18%. I've done some rough calculations year by year. With this $90 million issue, we're going up 30% the next year, 31, 32, 34, 35. The amount of debt service is going up by double digits very significantly and very quickly. Okay, so why is that happening? Well, we had $280 million outstanding of debt. When you add 90, that's an additional 32%. Historically, before I got here, we're normally borrowed at most 15 to 20 million. As the school's construction program kicked into gear, it's been increasing during my tenure to 40 to 50 million. Now we're looking at 90 million. Okay, all those approved projects that were not funded are now coming home to get funded. So if our debt balance goes up by 32% and our interest rates are doubling from 22 months ago, and they've gone up 75% in the last 6 to 9 months, that's why when you get to debt service, it's escalating 30 to 40%. Again, I've been cautioning for a while that the two major ratios, or at least the ones that I think are most important, but the two major ratios that the rating agencies will look at is what is our total debt, and they compare that to the grant list. And then what is our debt service cost, and what is that as a percentage of our total operating expenses? So the total debt is going up very high this year. And the debt service, just because of all the inflation, is going up significantly. If and when we lose our AAA rating, that will also increase our interest cost. So what will happen is debt service, which is about 10% of our operating expenses, will go up to 15 to 20% in the coming years. And in my mind, the way we talk about it in finances, assuming we can only spend so much because the taxpayers can only withstand so much of tax hikes, this debt service will crowd out other operating expenses. It'll be a very painful issue. If we increase the operating expenses like we have historically, and I think we've been trying to be very reasonable about that, combined with the debt service, those are the risks that I foresee. Bill, would you like to make any comments and let me rest my throat?
There we go. No, I think Henry, I think you framed it very well. I mean, in terms of the market, the municipal bond market, we've seen municipal rates for AAA issuers increase 2 percentage points, 2 full percentage points since January. So 200 basis points. And Henry's right. Unfortunately, it's a daily occurrence where we're seeing, kind of a death by 1,000 cuts. Every day it's 3 to 5 basis points of increase in rates. We're coming off of historic lows. So, currently it's, we're in that 3.5 to 4% range, depending upon which the term we're talking about. It's not a point where it's punitive yet, but the question is how high do these go, especially given where inflation is. And we had the CPI print came out yesterday. Again, it was over 8% year over year. That's the second month in a row. So there is some concern here. about, where the direction rates are going to go over the next, 12 to 18 months.
I would just add something that I noticed that was a little eye-opening. So you have a general increase of rates. The Fed wants that. So they're increasing their benchmark rate, and all the other interest rates in the finance world play off of that. But for 17 or 18 weeks now, specifically in the municipal bond market, there are two major sources of funds, which are mutual funds and exchange traded funds, ETFs. And just like anything else, you could have them for stocks, for oil stocks. There are mutual funds and exchange traded funds for municipal bonds. Last year, when we got very good rates, those funds were increasing in size week by week when we went to market. And it's a supply demand game. So if money is coming in to buy paper and the supply is limited, and we are one of the few Connecticut AAAs, we get the benefit of lower rates. But with the outflow of these funds from those bond markets, we now have lower demand and higher supply. Everybody wants to come to market before the rates go even higher. So it's not just general interest rates, but also specifically in municipal bonds. Municipal bonds investors lost 10 to 15% in the first quarter of this year on their investments. So many of them are cycling to other investments. It's just another phenomenon of what we're up against.
Yeah, and that's a really important point, Henry. The actual numbers were in calendar 21. There was really it was almost an insatiable demand. There was positive flow funds, so money going into bond funds in 47 of the 52 weeks of the calendar year. This year, it's been negative. It's I think it's 11 straight weeks now. And there's significant amounts coming out on a week-to-week basis. And so Henry's right, just from a supply demand perspective, is that demand is waning. What does that do? That's driving down prices, right? And for bonds, price and yield work inversely to one another. So the prices are coming down and the yields are going up. And so that unfortunately is not abating. And it isn't expected to until really rates stabilize. And that's going to largely be driven by the Federal Reserve's, monetary policy tightening that's projected to continue through the end of the calendar year here, or at least well into the fourth quarter. So the fund flows is a concern. I guess the one positive note about the fund flows is the timing. The city's timing of its annual issuance is intentional. And we do it in July, mid to late July, because there are historically a lot of bond redemptions that occur in July and August. So meaning investors have bonds that mature and they have money available to reinvest. So we've historically targeted that time frame, and we're hopeful that will offset to a certain extent the fund flows, the negative fund flows, but it's not enough to have to cover that amount. I mean, and it's been, it's been 2 to 3 billion a week is the number that's coming out. It was 2.67 billion a week ago, and it was 2.88 billion the week prior to that, just to, kind of give you a sense of the order of magnitude that we're talking.
It looks like Bill froze on us for a second.
Am I back?
Oh, he's back now.
Okay.
Yes.
Yeah. So I mean, that was really, that's all I kind of had. I think Henry covered it very well with his narrative. So.
Are there any questions or comments?
My only comment would be that, Henry, we've spoken about this with other funding And just to watch it actually playing out right now is actually kind of scary. And secondly, I really needed you in college. Like you make things so like easy to understand. So I just wanted to say that, like, I appreciate it, but it just brings me right back to our phone call and our concerns, especially for our residents. So it's in live picture now, you know.
I'm just going to add, I wasn't sure I was going to talk about this, but Bill and I tried to be creative. And I think, Nora, you were the one who said, why don't we borrow all the money now if we know rates are going to go up? So I explained that with tax-free bonds, we can't do that for a number of reasons. But there's a taxable bond market that's out there. And last year, it had been at a historically small premium to the tax-free market. So I explored with Bill and our investment bankers. We have 220 million, then we need to borrow for. So what happens is, if we borrow on a taxable basis, we have two benefits, and I'll get into IRS law as little as I need to. As I told you, when we borrow tax-free, we have to spend it within 3-4 years. If we borrow taxable, there's no requirement. So we could put it in the bank and we can invest it. And if we're going to spend that money over 5 years or 10 years, draw it down. Now with tax-free bonds, we're also limited in how much we can earn on what is known as the unspent bond proceeds. In essence, the federal government is giving us a break on tax rates, on interest rates. So we could borrow tax-free, let's say at 3%. And then we could turn around and buy treasury bills from the government at 5% and make what's known as an arbitrage profit. So they have many, many rules, hundreds of rules and regulations regarding that. So they get you on the way in, you have to spend it quickly, and on the way out, until you spend it, you're not allowed to earn more than your borrowing costs, okay? But if it's taxable, we don't have that restriction either. So the idea Bill and I bounced around is, what if we borrowed that 220 million, we borrow it taxable, we can invest it, and there are no restrictions. There are restrictions on us as a municipality into what securities we can buy, but there's no restriction on the interest we can earn. So if interest rates are going up and we lock in 4% and we can earn 5%, we're making money by borrowing while we wait to spend it. So we had the guys run the numbers. Unfortunately, I guess I'm not the only one with that idea, and that spread has widened to 95 basis points, and the numbers just didn't work. In essence, we'd be making a very big bet on interest rates that we're going to pay that 95 basis points now and hope that the rates go up consistently so that we can cover it on the other side. If the bump was lower, that's a reasonable bet. But given where the market is today, we all agreed that that wasn't a risk we wanted to assume. So we did try to be creative. The reality is it's a tough market. We sort of knew that after last summer. The 90 million is not such a surprise, but we knew that eventually the 220 million is going to be spent. And so here's where we are.
Councilmember Nora Najelski-Eichner, and then Councilmember David Hooverman.
Thank you, Chair Burnett. And thank you, Henry and Bill. This has been an incredibly helpful presentation. And Henry, I really appreciate the creativity and the thought going into this. My question, we may want to come back to at the end if folks have questions on this presentation. But I wanted to ask you about the news that came out yesterday that we will be moving to a 60% reimbursement rate for all school construction going forward. Now, I know this obviously does nothing to alleviate our 220 or now our 300 or 250, whatever the outstanding amount is. I understand that this does nothing to resolve any of the retrospective, but I did wonder, and again, if there's immediate questions, we can come to this at the end, but I did wonder if you could talk a little bit about the impacts that has for your projections going forward in terms of sort of, again, whether that is going to help decrease the slope of our rising sort of demand for capital funds and how that might play out.
Sure, I'm happy to address that. So the Board of Ed came out last year with a 25-year plan. And net of reimbursements, the total was $450 million. Now, there are certain facts that we must remember. As I've learned from the building management team, every year there's a delay, costs go up 4%. I once had the temerity to ask, wasn't there a recession in Connecticut also in 2009, 10, and 11? And when there's a recession, businesses go out of business. The firms that remain lower their prices and costs. And they said, no, 4% a year. And that's something that's just built into construction costs here in Connecticut. So that 450 isn't real. It's what we call nominal dollars, not real dollars. And those numbers will get inflated. The second thing is that there is a definite, we have to thank Senator Bob Duff, who got us the 60% versus the 22%. So that differential of 38% on the 450 million is 171 million. Okay. And I love the fact that it's not hard dollars, it's a percent. So if the 450 goes up to 550 or 600, the reimbursement will go up as well. So that's a pure offset to that number. It's a very ambitious plan. It's stretched over 25 years. The real issue is where are interest rates and what does that do to the debt service cost? And what does that do to our tax rates? It's a three-carom shot. Ultimately, it comes down to, you know, we can spend, we can tax, and then we borrow. And when we borrow, the debt service is a feedback loop that goes back into the tax. It's part of the tax rate. So the numbers keep going up on the cost side. Okay, we've kept the tax rates going up in the 3 to 4% range, but they've been supplemented by drawdowns from rainy day funds and by ARPA funds. If we didn't have those, the tax rates would have gone up 5 or 6% just because of spending. On the revenue side, remember, 90% is our real estate taxes, and 5% are going to be the motor vehicle and the business personal property. So unless the total value of housing in the city goes up, I don't see where the revenues are. For our models, we said every 5 years, the grand list might go up 1 to 2%. I just don't see where the big revenue increase is. And we're also going to have the issue because during COVID, the demand for office space went down and the demand for residential in suburbs like Norwalk went up. So there'll be a shift of the tax bills to the residential. Residential will go up and commercial will go up lower. So those are the big picture factors I see. Excuse me so much. It's just a question of how do we balance that? It's revenue, expenses, taxes. The expenses keep going up. 70% of our costs are payroll. They go up. Right now it's 2.35% with the union contracts. With inflation, the next contract, it'll go up higher. That's just how we run. The number of people that we employ is generally constant. And then on the revenue side, yeah, we might get some more revenues and fees. We might get more intergovernmental revenues when the state gives us more reimbursements, which is welcome. But the ARPA money is going to be gone. Hopefully we don't have COVID, so we don't have COVID reimbursement. So I don't see where the revenue's coming. So the big picture that I see is our tax rates have to go up to cover these expenses. And I don't know enough about our citizens and the growth and what's happening to them and the economic financial pressure they may feel. And the biggest concern is people are talking about stagflation, which I lived through in the early 80s, late 70s, early 80s, where you have very high inflation. It got to 20% at one time, and a recession. So people are losing their jobs, businesses are going out of business, and at the same time, the cost of living is going up very high. And I just worry about our citizens and our taxpayers, but I'm not sure what to do about it. The costs, we tighten as much as we can. Excuse me. With the recommendations from the efficiency study, we're going to try to implement their suggestions to save some money. Revenues, we have taxes, we have fees in certain departments. I don't see that going up too high. So there are only so many ways to stretch. I'm open to steal good ideas from anybody.
Thank you, Henry. I appreciate it's a dark picture, but it's helpful to have a realistic one. And I appreciate that.
Councilmember David Hooverman.
Thank you, Chairman Burnett. Hey, Henry. I have a couple of questions. One is the 220 million appropriated unbonded. Do we have a list of what those projects are in the year that they were passed in? And is that something?
I believe I shared that with Chairman Burnett, and I thought he distributed it to everyone on the committee. The list of 220 million, the outstanding. We can do that again, Dave.
Yeah, I one, I'd like to see that. Next is this resolution, this 38.9 is, again, goes into the potential. That's of the, or is that of the 90 million that you're talking about bonding in the bond series for 2022?
I think, gotta be careful not to mix the numbers. The 38.9 is new approved capital projects.
Some of which will be bonded for.
One second, before we get to bonding, excuse me, before we get to bonding. So the 220 goes up to 260, right? 39,
Right.
okay, ballpark. Now, if you remember, I did the cash flow forecasts. Out of the 220, they said we're going to need 59 million, call it 60. Out of the 40 million, the 38.9, they needed 28. Makes sense. 3/4 of our current budget is going to be spent within 12 months. So the 90 is 60 out of the old and 30 out of the new. But if you say 220 plus 40 is 260, and then you take off 90, okay, the 220 finally is going down. Okay, the 260 minus 90 is now 170 because we're taking a big bite out of the old approved but not yet bonded.
I understand that. What I'm asking is, do we have a list of the actual projects that are being bonded, that are going forward on this bond issue, and the projects that are still in hold, so to speak?
Yes.
Okay,
Remember,
can we see that? I would like to see
get a
that.
projection. We get a projection of what the managers of these projects expect to spend over the next 4 quarters. And it's project by project. Then we did the same for the 38.9. Project by project, what do you need? Because unless they do it from the bottom up like that, I don't trust the numbers. And they say, oh yeah, this is a project, but we're only going to need to do it in the spring, that sort of thing. And so, and we've been doing it now for about 2 years, Chitsmay and I. So the managers have learned to think it through the way we ask from a cash flow point of view. And they're looking at not just the cash outflow, but also the inflow they may get on reimbursements.
Okay, and we can see that you have that laid out.
Absolutely.
All right, I'd love to see that. Thank you.
Sure.
I believe it was maybe 3 or 4 meetings ago that we stepped, I think it was the January meeting that we had requested that, and we stepped through it during the meeting. David, Councilmember Hooverman, I'm not sure if you were at that meeting, but we stepped through line by line each
Right,
project.
I remember that, but I also want to see how this bond issue impacts that, bringing which projects are now moved forward off the, off that list and onto the moving forward bonded for money in an account.
So basically an updated list.
Yeah, an updated, all right, updated list. That's fine. Yeah.
Right.
Thank you.
Right, I can give you the cash flow projections quarter by quarter, which is what we used as a basis for determining how much we need to borrow.
Great. I'd like to see that. The next question I have is based on, I know we've seen now, and this maybe is more for Bill, but we've seen this increase over the last couple of years, and looking at coming out of a pandemic, what we're experiencing with inflation, with cost indexes, are we looking, are you and the analysts in the world looking at this trend continuing over the course of 2 or 3 years? Or are we looking at a stabilization of this trend?
I'll let Bill take that one.
Yeah,
I think Bill is frozen
I
again.
froze him. I'm sorry.
It was,
um,
I'll try to start. Bill, are you back?
I think I'm back. Am I back? Can you hear me?
Ah, there you go. Yeah.
Yeah.
thank you.
You're
Okay.
back.
I guess the question I have is which trend are you referring to? The inflationary trend?
Well, the impact with the inflationary trend, and then we're looking at the cost of borrowing money right now, the cost of issuing the bonds. You know,
Sure.
you were 1.75 2 years ago, and we're 3 point, what, I don't remember what the number is, 3.4 on the 15-year and 3.8 on the 30-year.
Right. Yeah, it's difficult to say with certainty, obviously, because there's a lot of factors that are in play here. I know there's a lot of disagreement over what is driving the inflation right now. Currently, certainly the war in Ukraine is a contributing factor. COVID and the supply chain is a contributing factor as well. And I think the expectation, at least of the bond market, is that the Federal Reserve is going to need to raise rates through the rest of this calendar year to get rates, which are now for the Fed funds rate at about 1%, to at least 2 to 2.5%, in order to combat inflation. If then opinion varies as do they need to go higher than that? Because again, we're talking about an 8% inflation headline number that includes, food and energy, which are proven to be very volatile right now. And if they raise Fed funds to 2.5, say 2.5, is that enough? And that really is what it remains to be seen, and we're going to have to monitor, is terms of, will that continue into calendar 23? There is, again, as they raise short-term interest rates, that does put a drag on GDP and economic production. And so that will, to a certain extent, slow, the economy. And the question is can the Fed come up with this proverbial soft landing that they're trying to accomplish, is going to be difficult. So, I can't tell you, I could tell you with confidence, I think through the end of this calendar year, we're going to see higher rates, and then probably into the first quarter of calendar 23. But beyond that, there's a lot of variables involved.
Do you look at the rates that you have here, the 3.4 and the 3.8, is holding till July when we issue this, when we do this?
Are
we looking at a possibility that we're going
Yeah,
to see a bump over the next month?
Yeah, and Henry alluded to this. I think that there's a strong possibility if things continue the rate we're on, they'll be slightly higher. I mean, again, today rates were up 3 basis points in the municipal market, 3 basis points, for every year in the yield curve, and that's kind of unfortunately been how it's been going. We haven't seen many days where we haven't had a small increase in rates, and so if that continues, then yeah, there's a likelihood it will be slightly higher.
So what we're talking about here right now, May 12th, we're not going to know where these spreadsheets actually fall, what Henry's done here for us until this is issued. I mean, we could see we could have a different picture in August or September than we have right now.
Short answer is yes. Again,
Okay.
because we don't really have the ability to lock in rates in May for a July issuance.
My concern is we're in a volatile time. We could see a significant move even before you get to that point. That's what I'm concerned about, is how that's going to impact us long term. So,
Right.
All right, thank you.
Council Member Jen McMurray.
Hi, thank you, Chair Burnett. I agree. It would be really helpful to have that list that Councilmember Hooverman was reporting on, just to see the update on projects and everything. But I have a two-part question. One, has there been a scrub, for lack of a better term, of the capital improvement list of what projects may not need to be done anymore or can move off of the project list at all? And then two, earlier this year, we had a meeting and Henry, you had spoken to us about cutting the capital improvement list and that should be done by July. I'm just wondering if you still feel that way. I'm assuming you do. And what we need to be looking at cutting in terms of a percentage or number.
That's the $220 million question. I've been talking about this for 2 years at least. And I feel a scrub would be great. I feel that maybe some projects can be identified that can be eliminated and canceled at this time. Maybe some can be slimmed down. Maybe there are 7 parts to a project and we only need 3 or 4 of those parts. Maybe some of them can be stretched out and delayed to the future because we have more debt capacity every year as we pay down debt. I've been talking about this, but there has been very little appetite from all the elected officials that I see in going back on approved projects and shrinking that. So that's been my experience.
Council Member Diana Ravalis, were you raising your hand for a question?
You're mute. You're mute.
Sorry. Can you hear me now?
Yes.
No, I was just agreeing with Mr. Dakowitz.
Okay.
What he was saying, I was like, yeah, exactly. And I agree. And I would be one of the ones who, as an elect, would support, and in our past dealings, understand what he was speaking of with certain measures that we were having to approve. Because for me, my concern, which what he just said, is how does this influence especially our residents, and our tenants, our homeowners, so on and so forth, which again, Henry, we spoke of. I was just agreeing.
Okay, thank you.
That's
The
all.
question I have, Henry, which I'm sure it has many, many tentacles in terms of possible answers, but the broad question is, what steps should we take to ensure our AAA bond rating?
Well, right now, the capital budget and the capital program and how much we're borrowing, and at these increasing rates, the resulting increases in the debt service costs are the biggest threats to our AAA rating. So I looked at the issues. There's revenues coming in, expenses going out, and what can you do on that basis? So on the operating side, 70% of our costs are payroll. And so those are contractually obligated. Plus we have contracts with outside vendors, which might have contractual increases or a certain dollar amount. The Board of Ed is a separate issue in the sense that the council can only agree to a certain number and is not allowed to direct them to spend the money in certain areas. So that's a problem. So that's the expense side. On the revenue side, it's our tax revenue from the real estate. I don't know, we built a $500 million mall. Yes, we're only getting 50% taxes during the abatement period, but that's $500 million of increased value. And the owners of that mall pay a proportionate share. They're now the #1 taxpayer in the city. I don't see any other developments like that are adding value to the major sources of revenue. So the capital budget is one area where we have all these projects we're going to have to borrow for. And if we can eliminate some, slim some down, stretch them out, that can only help. We can't do much about rates. We're sort of locked in and we borrow year by year. So I'm not sure what else. Bill, you work with dozens of clients around Connecticut. Can you offer some insight?
Yeah, I think certainly the pressure here right now on the rating is on the debt, right? It's a large increase from what the city has done historically. And so that's, something that's going to have to be managed. But the other thing that I guess I would caution against is what we tend to see, this is anecdotal, but what we tend to see happen where the fixed costs can go up, especially for debt, and become a larger piece of an operating budget. Oftentimes, issuers will, in a reaction to that, will become less conservative in their other budgetary assumptions. And as a result, where they may have appropriated some fund balance for tax relief and been able to replenish it through their conservative budget assumptions and generating positive operating variances, as the debt load goes up, those variances tend to come down. And what happens is you start to not replenish the appropriated fund balance, and now you start eating into your reserves. And that really is when the rating agencies really start to move quickly on the ratings. And so to the extent that you can maintain the fiscal discipline that the city has historically had and how it budgets, I think would help insulate it to a certain extent with the debt. Unfortunately, the dollar values that are being discussed are very large, and as a result, there's tinkering around on the margin isn't gonna save it. But you can stall a little bit on the rating action potentially by maintaining fiscal discipline and maintaining the high reserve levels, which would be a bit of an offset, at least temporarily.
I would also add, I don't want to be so negative. There are two very strong positives that we have that we should be proud of. One is, I believe we still have the largest rainy day fund in the state. And debt holders especially, they look through the budget, they look through the individual line items, but they say, I've got this $70 million cushion that if everything goes to hell in a handbasket, they can use that 70 to repay the bondholders. And that's what the credit rating is for. So they view that very significantly. And that's a big positive for us. The second thing is that most local governments, city, county, state, they have serious issues with their pension plans. The state of Connecticut, Illinois, California, you've heard about those. I'm very pleased that as of the last audit, we have 4 pension plans that average over 90% funded. And our OPEB trust fund, that's other post-employment benefits, which is mostly healthcare costs for retirees. Half the cities in Connecticut, I believe, don't even have a trust fund for that. Our trust fund was over 100% funded as of June 30 last year. Now, it's not like a piggy bank that once you get to 100, it can only go up to 105, 110. If the demographics of our employees change, so we had early retirement. The actuaries projected that a certain number of employees would pay into the system until 65. If they retire early, we lose that. If they start drawing down benefits before 65, we lose that. That's a cost. So even though we're at above 90% and over 100%, it can slide back some. It's still probably in the top 5% of local governments across the country. So I think that's a big positive as well. Most other municipalities have that as an albatross, and they look at every year and say, how much more can we pay in to get that funded ratio higher? So those are two big positives that we will obviously highlight when we talk to the rating agencies.
Councilmember David Hooverman.
Thank you, Chairman Burnett. We talk a lot about the AAA bond rating. The moving, if we get into a situation where we end up in a AA bond rating for whatever reason, are we talking about multiple basis points shift on the money? What is the number? If let's say this year we were doing this as AA.
So just to be clear, right? So AA would be 2 notches, right? So the rating scale would be, AAA is obviously the highest, right? And then if the equivalent would be AA1 from Moody's, or AA plus would be 1 notch. AA would be 2 notches. Right
Okay.
now, it's about 15 basis points for 1 notch. So to go down to AA, which would be a 2 notch, you're looking at about a third of a point. And again, it's a dynamic number. The credit spreads change based upon market conditions. They had been very tight when demand was high. Now that demand is waning, they're starting to widen out and they're gapping out a little bit. But yeah, it would be 30 basis points today.
Okay. Thank you.
Okay, are there any other questions or comments?
Thank you for your work, guys.
Thank you. Diana, congratulations on your blessed event.
Thank you so much. I appreciate that.
Henry, do you think we would be in the position to have that updated capital project list by the next meeting, or?
Oh, absolutely. We already have those.
Okay.
We haven't updated the 220 million of historical, but I think if we show you the cash flow projections relating to that 220, you will, for each project, we have authorized budget, how much has been spent to date, expected reimbursement, how much has been received to date, and what's left. And so they give us the projections for the next 4 quarters of what they expect to spend. So you can get net totals project by project. Some have not been started at all. Others have been commenced quite a while ago, and they're finishing up. And you can see it's project by project rolled up into department by department. And I think Chitsmay and I could probably circulate that very quickly.
Great, that'd be appreciated. I think that will be the start of at least the Finance and Claims Committee reviewing the capital projects. And then after we receive that information, we could have dialogue in terms of to the comments that were made about what actions we need to take in terms of possibly changing the position on some of these projects to ensure that we're in a better financial situation.
That would be excellent, and I endorse it 100%, and I'll try to get you that data as quickly as possible.
Great. Council Member Norman Najelska-Eichner.
Thank you, Chair. And Henry, this may be something you already do, or this may be a much larger ask, in which case, of course, it should be, delayed until after the bond issuance, and when you have time. But have you all done projections sort of commensurate with the school's 25-year capital improvement plan? So do you have sort of a projection out we can look at for what bonding would need to happen each year if that 25-year plan was followed?
Tom Hamilton, the former CFO, presented that schedule, I'd say 6 to 10 months ago. So I could just pass that along to let you know they have project by project, school by school, and a calendar going out 25 years. I believe what they tried to do in the front end years was to do a school every 2 years. And then they started doing it annually. And he has, excuse me, he has the projects listed item by item. So again, that's something we have in our file banks, and we could probably circulate that very easily.
Thank you. I think that'd be very helpful to see, given sort of the magnitude of the school construction need going forward. So I would appreciate that. Thank you very much.
You're welcome.
Bill, great work with you too. I don't want you to feel overlooked.
Thank you.
Are there any other questions or comments related to the city's debt service? We have a couple of follow-up actions as a result of this discussion, and we'll address them beginning the next Finance Committee meeting as it relates to the several capital projects that are that schedule. We'll review that schedule to see what changes need to be made, or suggestions. Let me put that, suggestions that we might bring forward. Okay, if there's nothing else,
Motion to adjourn?
yes, all those motion is adjourned by Council Member Diana Revolus. All those in favor show by sign of aye or verbally saying aye. Thank you. Great. It's unanimous. So thank you, Henry. Thank you, Bill, for your expertise, and Tom also. Tom Ellis still on, and we stand adjourned. Have a great rest of the evening. Thank you.
Have a good night.